Getting into investments is a great move for building wealth and security, but it can also lead to a hefty tax bill if you're not familiar with how and when the IRS applies taxes to investments. Welcome to the Finance Home Friend. Bev here, and in this video, we'll explore 5 common types of taxes and investments and share some tips on how to reduce the amount you owe. But before we move further, do us a solid favor. Smash that like button, hit subscribe, and ring that notification bell. By supporting our channel, you're not only staying in the financial know-how, but also helping us grow and reach even more folks on their journey to financial mastery. Let's dive in. When it comes to taxes on investments, there are a couple of things to keep in mind. First up, there's the tax on capital gains. This is basically the money you make when you sell something valuable, like stocks or property. If you held on to it for more than a year, the tax rate can be 0%, 15%, or 20%. But if it's less than a year, it aligns with your regular income tax. To ease the tax burden, you can use losses from other investments to balance out your gains, a smart move called tax loss harvesting. Next on the list is the tax on dividends. These are like rewards you get for owning certain stocks, and they can be taxed too. There are 2 types: non-qualified and qualified dividends. The tax rate for non-qualified dividends is the same as your regular income tax, while qualified dividends can be taxed at a lower rate, at 0%, 15%, or 20%, depending on your income and filing status. To stay on top of things, you'll get a form in the mail detailing your dividends. If you want to minimize this tax, consider holding onto your investments for a bit longer to qualify for a lower tax rate. Also, be sure to set aside some cash for taxes on your dividends to avoid any surprises. And here's a tip: if you keep those dividend-paying investments in a retirement account, you might be able to put off those taxes. Smart moves, right? When it comes to taxes on your investments in a 401k, here's the scoop. Usually, you don't pay taxes when you put money into a traditional 401k. And while your money is chilling in there, no taxes nibble at your gains or dividends. The tax moment only arrives when you decide to take some cash out. On the other hand, if you have a Roth 401k, you pay taxes up front. But when you retire and start cashing in, those withdrawals are tax-free. Now for the nitty-gritty. With traditional 401ks, the money you pull out is taxed like regular job income in the year you take it. But here's a heads up. If you decide to grab some money before hitting 59.5, there might be a 10% penalty, plus the regular taxes. Exceptions apply though, and if you wait too long after 72 to make withdrawals, a penalty might pop up. To keep things in check, explore exceptions to the penalty if you're taking money out before 59.5. You can also consider strategies like tax loss harvesting, borrowing instead of withdrawing, or rolling over the account to ease the tax load. Now let's talk about mutual funds and their taxes. These funds can bring in taxes on dividends and capital gains while you hold on to the shares. And when you sell those shares, there might be capital gain taxes too. Here's how it works. Your mutual funds might cuff up dividends, interests, or capital gains. And guess what? Taxes might be waiting for you, even if you don't sell any shares or get cash. The tax rate depends on what kind of distribution you get and some other factors. Selling your mutual fund shares for a profit could also mean facing capital gains tax. To ease this situation, consider waiting at least a year before selling your shares to score a lower capital gains tax rate. If you keep those mutual fund shares in a retirement account, you might delay the tax on interest, dividends, or gains. Other tricks include tax loss harvesting and picking funds that are less likely to dish out taxable income. When it comes to selling your house, here's the lowdown. If you make a profit, some of it might be on the tax radar. Here's the drill. The IRS usually lets you skip taxes on up to $250,000 of gains when you sell your main home. And if you're hitched and filing together, that's a sweet $500,000. For instance, let's say you and your spouse snagged a house a decade ago for $200,000, and now you're selling it for $800,000. If you're filing your taxes together, you might not have to pay taxes on $500,000 of that gain. Yay. but the other $100,000 could still face a capital gains tax. The rate of that $100,000 depends on your income and how you file your taxes. Now, here's the scoop on dodging some of that tax. You gotta meet specific criteria to qualify for this exclusion, so check those boxes before you put that for sale sign up. There might be exceptions that work in your favor, and don't forget to factor in the value of any home improvements you've made. They might just save you some tax bucks. Easy peasy, right? In summary, it's important to understand the basics of taxes on investments to make wise financial decisions. Taxes on capital gains, dividends, 401k investments, mutual funds, and the sale of a house can significantly impact your financial bottom line. By learning how these taxes work, you can take strategic steps to minimize your tax bills and optimize your investment returns. Investors who go into the intricacies of each tax type gain insights into the timing, rates, and potential exemptions associated with their investment decisions. For example, you can employ tax loss harvesting to offset capital gains, hold investments within retirement accounts for tax deferral, or leverage the exclusion on primary residence gains. These strategies empower individuals to make informed choices. It's important to note that taxes on investments are not static. They change with financial circumstances, tax laws, and life events. Regular review and adjustment of financial plans, coupled with awareness of available tax minimization tactics, ensure that investors stay agile and responsive to the dynamic nature of the financial landscape. When it comes to investments, knowledge is power. As you take on your investment journey, staying informed about the basics of investment taxes equips you with the tools to protect your wealth and enhance your financial prosperity. Remember, every dollar saved on taxes is a dollar that can be strategically reinvested to foster your financial growth. Just a reminder, this isn't financial advice. It's more like sharing helpful money info. Everyone's money situation is different, and success isn't guaranteed. Before big money moves, do your research and talk to experts like money advisors or tax pros. They can give you advice based on your specific situation. Hope you found those investment tax tips helpful. Now, here's a question for you. What's your go-to strategy for minimizing taxes on your investments? Drop your wisdom in the comments below. If you want more money insights, make sure to hit that like button, subscribe, and ring that notification bell. Stay financially savvy, and we'll catch you in the next one.